Peter Lynch is often introduced as the legendary manager who turned the Fidelity Magellan Fund from a relatively unknown mutual fund into the single most successful fund of its era. But behind the breathtaking numbers, 29% average annual returns for 13 straight years, there lies a deeper mystery. How did one man actively manage a portfolio that at times included over 1,400 different stocks and still outperform the majority of Wall Street professionals who were managing only a fraction of that number? The answer lies in Lynch's unique portfolio management technique, a blend of broad diversification, decentralized research, relentless curiosity, and a willingness to challenge conventional investing dogmas. Lynch didn't believe in owning only a handful of large companies that everyone on Wall Street already knew. He believed the greatest opportunities were hidden in plain sight inside malls, grocery stores, neighborhoods, and local business trends that everyday consumers could observe long before professional analysts caught on. His now famous motto, "Invest in what you know," wasn't just a slogan, it was an operating system for discovering multi-baggers, companies that could grow 5x, 10x, or even 20x over time. But seeing the opportunity was only step one. Managing it within a massive portfolio was step two, and that is where Lynch excelled beyond any other fund manager of his time. Lynch believed that portfolios must behave like gardens: you plant many seeds, nurture the promising ones, and ruthlessly remove the weeds. He often said that a single 10-bagger could make up for dozens of small mistakes. Therefore, his priority wasn't perfection, it was exposure to potential greatness. However, unlike many investors who merely traded based on news or quarterly headlines, Lynch was obsessed with understanding the businesses he owned. He visited hundreds of companies a year: factories, restaurants, warehouses, hospitals, any place where he could see with his own eyes what was happening behind the numbers. To him, the stock market was not a casino but a giant representation of American innovation, and his job was to uncover the best growing pieces of it before anyone else noticed. His portfolio structure reflected this philosophy. It included a wide range of categories: fast growers, stalwarts, slow growers, asset plays, turnarounds, and cyclicals. This balance allowed him to remain adaptable across different economic cycles. When inflation rose, some companies benefited. When technology boomed, others soared. When the market panicked, turnarounds emerged as opportunities. Lynch managed all of them simultaneously, a tactic most investors believed to be impossible. Yet Magellan continued to outperform year after year. Another secret was that Lynch didn't obsess over macro predictions. He believed that trying to guess recessions or interest rate outcomes was a losing game. Instead, he focused on the micro, the specific characteristics of great businesses. Was earnings growth real and sustainable? Were customers loyal? Were competitors weak or distracted? Was management honest and ambitious? This bottom-up research approach allowed Lynch to ignore market noise and stay anchored to business fundamentals. As long as the company kept executing, he stayed invested even if the broader market disagreed temporarily. Lynch was also a master of capital allocation. When a winning investment proved itself through continued performance, he added more instead of selling early, one of the most common investor mistakes. He often repeated, "Cut your losses and let your winners run." It sounds simple, but emotionally it is extremely difficult. Most investors are eager to take quick profits to feel smart and avoid regret. Lynch did the opposite. He rode his champions for years, letting compounding work its quiet magic. Another unconventional element of his strategy was his willingness to embrace small and mid-cap companies. While most large funds avoided them due to liquidity concerns, Lynch saw them as fertile ground for exponential growth. These companies were often under-researched, misunderstood, or underestimated. Many of his greatest wins, like Taco Bell, Pier 1 Imports, and Dunkin' Donuts, were found not through Wall Street reports, but through everyday observation and curiosity. Despite managing billions of dollars, Lynch structured the Magellan Fund as though it were still a scrappy, nimble, hungry investor searching for the next breakthrough brand. But diversification came with danger too: how to keep track of so many holdings. Lynch's solution was both simple and brilliant: categorize every stock and constantly review its performance against its category expectations. If a fast grower slowed down, it shifted categories or was sold. If a turnaround executed its plan successfully, Lynch increased his stake. For him, owning a stock was never a static decision, it was a living, evolving evaluation.
The secret wasn't the sheer number of positions, it was the discipline behind them. Lynch also developed his famous story framework. If he couldn't explain in a simple sentence why a company deserved to be owned, it didn't belong in the portfolio. This forced clarity kept him from falling into the trap of complex narratives that only sound smart but lack real business justification. He believed that if a retail investor couldn't understand a company, neither could the people running it. His humility about uncertainty is also worth noting. Lynch never claimed certainty about any single stock. Instead, he spread his bets across many different ideas, ensuring that even if some failed, the successes would drastically outweigh them. And they did. Ultimately, Lynch's portfolio management technique was not built around genius stock picking alone. It was built around systems that rewarded curiosity, punished stubbornness, embraced flexibility, and rejected the illusion of perfect prediction. At the peak of his management, Magellan's returns were so consistently strong that millions of Americans placed their faith in Lynch's strategy, turning the fund into a national icon of wealth creation. What Lynch accomplished wasn't just financial dominance, it reshaped the entire worldview of professional investing. He proved that active management, done correctly, could outperform the market. He showed that everyday observations could be more valuable than complex financial models. And he demonstrated that with the right strategy, the power of compounding could lift ordinary companies into extraordinary wealth engines. But how exactly did he apply this management style day to day? What rules guided his buying and selling decisions? And how did he protect himself against his own confidence turning into blind optimism? In the next chapter, we dive inside Lynch's practical playbook, the real operational techniques that allowed the Magellan Fund to grow faster and stronger than any other fund of its time, without losing control to chaos or complacency. Peter Lynch's day-to-day portfolio management approach was a relentless pursuit of truth about the businesses he owned and the ones he considered buying. Unlike many fund managers who spent the majority of their time locked inside offices obsessing over models and quarterly forecasts, Lynch was out in the real world, walking store aisles, talking to managers, observing consumer behavior, making constant notes. He considered Wall Street to be too enclosed, too trapped inside its own assumptions. The real signals, he believed, were happening outside the city's financial towers, in suburban shopping malls, fast food chains, industrial parks, and airports where real customers interacted with real products. Lynch often described his process as turning over rocks, a metaphor that reveals his core belief: opportunities are everywhere for those who are curious enough to look. Many investors avoid research because they want shortcuts, charts, rumors, analyst ratings. Lynch avoided shortcuts because he believed truth lies beneath the surface. At Magellan, his daily routine reflected this mindset. He reviewed companies constantly, not based on whether the stock price went up or down, but whether the business was improving or deteriorating. As long as the fundamental story stayed intact, growing earnings, expanding markets, competitive advantages, he held strong. Even if the stock dropped sharply, he often increased his position, recognizing the discount as a chance to enhance long-term gains. This made him appear contrarian, but his approach was more nuanced. Lynch didn't simply buy falling stocks, he bought companies where the temporary price decline contradicted improving business performance. Conversely, if the business story fell apart even if the stock was at a new high, he exited without hesitation. Emotional attachment was the enemy. Sell your losers, let your winners run wasn't just a slogan, it was a constant discipline. Lynch believed one of the greatest mistakes investors make is selling great companies too early just to feel like they locked in profits. A 10-bagger doesn't reveal itself in its first 20% surge, it reveals itself over years of compounding. Lynch's portfolio was filled with companies that didn't look impressive at first. Some were boring businesses: retailers, restaurants, local banks, regional utility companies. Lynch often joked that boring companies were his favorites because if the story sounded dull, Wall Street would ignore it. That ignorance created bargains. He would ask simple but powerful questions like, do they make something indispensable? Are they expanding? Are they gaining customers? Are they improving efficiency? If yes, then the stock deserved attention regardless of how mundane the business seemed. His categorization system was essential to managing such a diverse and growing set of holdings. Each stock was placed into a strategic bucket that defined expectations for growth and risk. Fast growers had high potential but required vigilance, they could stall quickly. Stalwarts were reliable, steady performers, the backbone of the portfolio during market turbulence. Turnarounds carried risk but offered sharp recovery potential. Asset plays required patience for hidden value to unlock. And cyclicals demanded timing and macro awareness. By knowing exactly what role each company played, Lynch prevented chaos and maintained control even as his portfolio ballooned beyond 1,000 stocks. Another key to Lynch's success was that he never tried to predict the whole stock market. He famously said, "If you spend 13 minutes a year trying to predict the economy, you wasted 10 minutes. Instead, his focus was always business-level performance. Even during market crashes, recessions, and political turmoil, Lynch remained grounded in earnings growth. If earnings continued to rise, then the price eventually followed, it was just a matter of time. Lynch also utilized what he called the 2-minute drill. If he couldn't clearly explain in 2 minutes why he owned a stock and what would drive future gains, then he shouldn't own it. This forced him to think with clarity and prevented him from falling into complex but unrealistic investment theses. He didn't want a smart-sounding story. He wanted a true story grounded in data and observable progress. His expectation was that every investor, professional or not, should be able to understand why they own a stock. Lynch believed simplicity was a competitive advantage. One of the most overlooked strengths in Lynch's management strategy was how he handled failure. He knew he would be wrong often, many of his stocks would disappoint. But his system ensured that no single mistake would ruin the portfolio. His losers were cut early, keeping them small. Meanwhile, his winners grew larger naturally through price appreciation and capital reinvestment. This asymmetric structure created a portfolio where downside was limited but upside was exponential. He often reminded investors that if you can find just one stock that grows tenfold, you can be wrong on many others and still do extraordinarily well. Another surprising element of Lynch's strategy was his willingness to constantly adjust and refresh his portfolio. There was no ego in his decisions. If a better opportunity arose, he didn't hesitate to rotate capital. If a thesis changed, he adapted immediately. This agility made Magellan both resilient and aggressive, two traits rarely found together in large investment funds. Lynch also embraced volatility. Instead of fearing market drops, he used them as opportunities. Declines in great businesses made him enthusiastic, not anxious. He encouraged investors to view volatility as the price of admission for superior returns. His comfort with uncertainty allowed him to stay invested while others panicked. Because of this mindset, the Magellan Fund surged higher after every market downturn during his tenure. Lynch maintained constant communication with Fidelity's team and traveled globally to understand new markets and innovations. If something had potential to become a nationwide or even worldwide trend, he wanted to see it early. Companies like Walmart, Home Depot, and Ford weren't just names on a screen, they were businesses he walked into, observed, and understood deeply. His primary question was always the same: is the expansion real and sustainable? If yes, he stayed committed for the long run. The result of all these strategic components was a portfolio that outpaced competitors not because it was risk-free, but because Lynch managed risk through diversification, alignment with business fundamentals, and elimination of emotional decision-making. Over 13 years, the Magellan Fund almost never stumbled. It seemed unstoppable. Investors trusted Lynch so deeply that the fund's assets exploded from $18 million to $14 billion. But with great success came growing pressure. Managing a portfolio of thousands of stocks while defending against market expectations became a monumental challenge. The world watched his every move, any mistake risked destroying his reputation. Lynch felt the weight intensely. Yet he continued pushing forward, believing he still had more to prove. As the final years of his career approached, the question hovered: could anyone maintain such extraordinary success forever? And what would happen when the greatest active manager of his generation finally decided to step away from the game? As Peter Lynch entered the final stretch of his extraordinary tenure at Fidelity Magellan, he found himself not just managing a fund, but also managing expectations, those of shareholders, the media, and especially Wall Street. Everyone wanted to know how much longer the incredible streak could continue.
His track record seemed almost supernatural. For 13 years, he had delivered an annualized return of nearly 30%, turning ordinary investors into millionaires and the Magellan Fund into the largest mutual fund in the world. But behind this overwhelming success, Lynch was becoming increasingly aware of the growing burden he carried. Managing billions meant every decision, every buy, every sell was dissected immediately by financial analysts. The pressure was constant. Yet Lynch maintained his philosophy: trust the research, trust the fundamentals, and trust the compounding power of great businesses. In these years, Lynch became even more vocal about discipline and patience. He warned investors repeatedly that markets are not predictable in the short term. A stock could drop 50% while the business itself continued growing stronger. The problem wasn't volatility, it was the investors' reaction to it. If investors panicked and sold at the wrong time, no amount of stock research could save them. Lynch famously said that during his career, the average investor in the Magellan Fund earned far less than the fund's performance. How? Because they bought only after a rally and sold during every correction. It was a painful lesson: even the best strategy fails if the investor lacks emotional control. Lynch's management at this stage became not only about picking winning stocks, but also about educating people to endure discomfort. He reminded them, the real key to making money in stocks is not to get scared out of them. While maintaining this strong conviction, Lynch continued refining his stock selection process. His scuttlebutt investigations grew deeper. He pushed analysts and researchers to uncover everything possible about the businesses under consideration. He wanted management interviews, store visits, supplier conversations, anything that could prove or disprove the investment thesis. His goal was simple: if you know a company better than most people in the market, you gain an edge that compounds over time. Another essential component of his success was his flexibility. Many legendary investors become rigid with age, locking themselves into one framework. Lynch remained adaptable. If something stopped working, he changed direction swiftly. If a new trend emerged, like technological shifts or consumer behavioral changes, he leaned into it early. He embraced innovation not as speculation but as progression. But even as Lynch excelled, he became introspective about the relationship between life and investing. The job consumed him: long hours, constant travel, endless meetings, and pressure from shareholders who demanded continuous performance gains. His family life was strained by the demands of his role. Lynch began to question what truly mattered. Did he want to spend the rest of his life proving himself to the market, or did he want to spend it with his wife and daughters, before the years slipped away? That question slowly reshaped his priorities. In 1990, at the peak of his career, he made a decision that shocked the financial world. At just 46 years old, Peter Lynch retired from professional fund management. The man who dominated Wall Street walked away without looking back. Herds of investors panicked again: how could the fund survive? But Lynch had already achieved what few ever do. He proved that an active investor could outperform the market, not by timing it, not by predicting recessions, but by patiently owning great companies at great prices. After retirement, Lynch didn't disappear. He transitioned into a role of teacher and mentor, writing books like Beating the Street and One Up on Wall Street, becoming a leading voice of investor education. His goal was no longer to generate billions in returns but to empower ordinary people to invest intelligently. Lynch urged them to believe in their unique advantage: knowledge of everyday products and businesses. He insisted that professional investors weren't smarter, they were simply too disconnected from real life. If a store is always full, if a product becomes wildly popular, if a company expands fast and responsibly, an ordinary person can see it before Wall Street's analysts put it in their reports. Lynch democratized investing. He turned every consumer into a potential observer of opportunities. His philosophy encouraged optimism, not blind hope, but confidence in innovation, entrepreneurship, and long-term growth. He knew markets would crash, companies would fail, and economies would struggle. But through all of it, human progress continues. Something better always rises from the downturn. That is why he believed in long-term investing as both a financial strategy and a worldview. Today, decades after Lynch stepped down, his impact remains massive. Investors continue to study his techniques, his stock categories, his focus on earnings growth, his discipline to cut losers and let winners run, and his unshakable belief that wonderful companies can change a portfolio and even a life.
The Magellan Fund's performance under Lynch remains one of the greatest achievements in investment history.
But more significant is the legacy he left behind: millions of investors empowered to think independently, observe the world, and build wealth steadily through logic and patience.
The final lesson Lynch offers the world is not about picking stocks. It's about humility.
He acknowledged that he made mistakes constantly, and that nobody, not even the greatest investor, knows everything. Success comes from learning continuously, making informed decisions, and most importantly, staying invested long enough to let those decisions bear fruit.
So when we ask, what was the true secret of Fidelity Magellan under Peter Lynch? The answer is surprisingly human. Curiosity, discipline, patience, courage,
a willingness to study, observe, and think differently, and a belief that progress, when supported by earnings and reality, not hype, will always find its way into the stock price.
Peter Lynch proved that the everyday investor has the power to win. They just need to stay in the game.
Thank you for joining me on this deep dive into Peter Lynch's extraordinary approach to portfolio management at Fidelity Magellan. His success reminds us that the stock market rewards those who stay curious, disciplined, and patient enough to let great businesses grow. If you truly understand what you own and why you own it, you are already far ahead of most investors. The lessons Lynch left behind continue to guide investors today: choose wisely, think independently, ignore the noise, and stay focused on the long term. Because wealth isn't built in days or weeks. It is built through years of conviction and consistency. If you enjoyed this video and want to explore more of the world's greatest investment minds and their timeless strategies, make sure to subscribe to the channel.
New episodes are coming soon, and you won't want to miss what's next.